Hello, everyone. Welcome to the Leaders for Global Operations webinar series. I'm Josh Jacobs, and today we're really happy to welcome Aaron Fyke, who's LGO class of 2002. He's the founder and president of Energy Cache, and he'll be talking today about the energy storage platform that his company's been building with the help of such distinguished investors as Idealab and Bill Gates. Aaron is a graduate of the University of Victoria, and before founding Energy Cache and after graduating from LGO, he was an investment director at an Australian VC company called Starfish, and since then spent time at the X Prize as well as some solar companies, and has an interesting and distinguished path to tell us about. What we're going to do logistically is just hold the questions till the end. Aaron has a presentation of about 40 minutes. And if you have any questions along the way, you can send me a chat using the WebEx, but otherwise we look forward to a great discussion at the end. Okay, so Aaron, take it away. Thanks.
Thanks. No, this is perfect. What I'd like to do is talk about a little bit about energy storage, a little bit about clean tech and the history of the clean tech financing, particularly over the last couple of years, and then some of the lessons learned I've had since founding the company. And so it's been an interesting path for the last 5, 6 or so years, and that's what I'd like to focus on today. So to start with, let me just jump in and talk a little bit about energy storage. Okay, there we are. So yeah, talking about the energy storage drivers, what we came up with as a solution, particularly why we focused on the solution that we did, and then some of the background with the investment bubble and how Energy Cache was started in light of all of that. So I'm the founder and CEO of the company. I've worked for a variety of clean tech technology companies, solar, fuel cells, ocean power, and the like, and the investors who've supported the company, as mentioned, are Idealab here in Pasadena, and then Bill Gates and Claremont Creek, a venture capital firm in the Bay Area. So here's what's interesting about energy storage, and the fact is, the grid has had limited storage for a very long period of time, and what that requires is a very intricate balancing of the energy that's produced needs to pretty much simultaneously be consumed. And so that makes it very difficult to manage any, network without any kind of storage, whether you're talking about inventory, whether you're talking about traffic. And so that leads to some capital inefficient solutions. For example, the generation capacity of the grid needs to be set to the highest possible point in a given year plus some margin, and then the rest of the time that capacity is sitting idle. So there are a number of drivers that are starting to come into play now that are really pushing the needs for storage beyond what has historically been the case. And the first of these is supply volatility, and that is a relatively new phenomenon. Supply on the grid historically has been baseload generators such as coal and nuclear plants, or peaking generators such as natural gas. But now you're getting supply in a big way coming from volatile sources such as wind, solar, and to some extent smaller renewables such as tidal and geothermal, although geothermal is less volatile. And so dealing with this volatility in supply is a management issue. And you can see here, this is a slide from the DOE projecting what would happen with 35% renewables. And the variability in the wind production causes coal plants to ramp up and ramp down in ways they really don't like to do. And so that's one major issue. The second is the one that I mentioned before, which is that you have a peak and off-peak demand curve. However, the peak load it's been growing faster than the average load for decades now, and it continues to do so. So not only do you have this peak off-peak problem with the grid, but the grid itself is getting peakier. And so you're deploying capital to build out a grid that's becoming more and more capital inefficient over time. And then the third major driver is transmission congestion. Siting and building a new transmission line is incredibly difficult. Nobody wants a transmission line built anywhere near them, and yet that's a major source of congestion on the grid. If you have storage, you have a management lever you can pull to mitigate congestion at various points on the grid, rather than just simply building out new transmission lines. So these are really the three major drivers that are pushing interest in storage as a grid solution. So what we've developed is we were really looking at the failures in the clean tech industry, and one of the biggest problems is the fact that it's not so much of a technology problem, it's more of a financing problem. And that is, there is capital available through venture capital investors for earlier stage companies, and there's a lot of capital available for proven technologies, but there's a big gap in the middle. And the customer set that a energy technology company is serving really has no interest or appetite or even capability of taking on technology risk. And so the biggest problem has historically been a company that develops their technology, but it's not proven, and then they try to get to market and there's no way to scale because they can't obtain the large-scale financing needed to build out an unproven technology. And then there's this catch-22 of needing a proven technology in order to obtain financing and needing financing in order to prove the technology. And so we really focused on existing solutions which are pumped hydroelectricity, basically. Pumped hydro is a well understood, proven mechanical solution that grid operators understand. And we wanted to replicate the performance of pumped hydro, but do this with a smaller footprint, with something that's easier to site, something that's more flexible, something with better cost and performance characteristics. And to do that, we wanted to borrow technology from other established industries to help get through this provability gap. And so with that, we turned to the mining industry, the aerial lift industry, ski lifts, and that kind of thing. And we developed this mechanical-based solution. And I've got a video here to show you what it looks like.
This video demonstrates the potential and the current state of the art for the energy cache system. Shown here is a mock-up of a 20 megawatt, 80 megawatt hour facility located in western Pennsylvania. Each installation is made from an array of individual lifts. At the top and bottom of each installation are the storage piles for the gravel. Each pile is capable of holding between 4 and 6 hours of energy. We now turn to the 50 kilowatt prototype built by Energy Cache in Irwindale, California. Each of the sub-assemblies will be described in turn. All of the power transferred into and out of the system is through the bull wheel, which is connected by transmission to the motor generator. At the top of the pile, when discharging, gravel is loaded into the hopper. The gravel then descends down the hill to the hopper pile below. At the bottom of the hill is the second storage site for the gravel. The gravel travels around the second bull wheel towards the dumping site, where the automatic dumping mechanism removes the gravel from the buckets. When this process is reversed, to store energy, gravel is automatically deposited from the pile via the hopper to the buckets traveling in the opposite direction. This gravel is automatically unloaded via a similar mechanism at the top of the hill, thus completing the storage process.
So, how did we get here? And this is the interesting history of clean tech financing. Back for the early part of the 2000s, oil prices have been escalating at a tremendous rate, and this has correlated well with interest in investing in clean tech. And I joined Starfish Ventures in Australia to invest in clean tech businesses in 2007. Right before this enormous growth up to $140 a barrel between 2003 and 2008. And here's the corresponding explosion in investment capital during that time, and which basically, in the 90s, clean tech was really not on anyone's radar significantly as a venture capital asset class, venture capital class. After the dot-com burst of 2001, 2002, investors were looking for other places to deploy their capital, and clean tech started picking up steam. And really, 2006, 2007, and 2008 were the extraordinary periods, partly driven by what was happening with oil prices at the time. However, and this led to some pretty phenomenal fundraising deals that were done during that time. What happened, though, in 2008 was the global financial crisis and ensuing recession, and this caused obviously a massive collapse in the Dow Jones. This caused a tremendous change in oil prices, corresponding to the time that I returned from Starfish back to the U.S., and resulted in a massive contraction in investment into the clean tech space for a variety of factors. The first, obviously, is due to the recession and the collapse in oil prices, there were concerns of the relevance of clean tech. But second, there was a very interesting phenomenon which occurs in private equity. What I'm showing here is a typical arbitrary portfolio of a large investment fund, say a retirement fund, and they would have roughly a quarter allocated towards domestic equities, a quarter for international equities, say 7% for private equity, fixed income, and then a variety of other things. Private equity, public equities are it's very easy to see the value of public equities. You just look at the quoted prices on the stock market. Private equity is not valued easily because it's not commonly traded. When you get a situation where there's massive collapse in value of an investment fund, there's a very strong incentive not to update the value of your private equity holdings. If the value of your fund is collapsing, you want to try to prop it up as best you can, and one way to do that is to not discount what you hold in the private equity sector as much as what is being forced to be discounted in the public equity sector. And what that results in is, if you have a massive collapse in value of your public equities, without doing anything, you now end up in a situation where you're heavily over-allocated towards private equity in the proportional investment that you wanted to split your fund up. And so that results in not deploying any more capital to private equity. In fact, if anything, clawing capital back. And that resulted in a very large reduction in funds from the LP community, the limited partner community, the large pension funds and investment funds that give money to the venture capital community. That resulted in a large reduction of money going to VCs, which resulted in a large reduction of VC money going to clean tech investments. So that was a very difficult time post-2008 for that reason, simply due to the mechanics of how people manage funds. So the result of that was that there's a large reduction in capital going towards clean tech Series A investments. A lot of funds that had already made investments in the clean tech industry then reserved what little capital they did have to supporting the investments that they had already made into later stage investments, the Series B, C, D rounds. And so there was an overall reduction in investment volume for the Series A investments. Sequoia Capital had a very, reasonably famous within the VC community presentation called RIP Good Times, predicting the sharp drop in funding happening in 2008 and the desert that would follow. And what resulted from that is a migration of investment partners away from a number of firms. These are firms that used to invest in clean tech deals that quietly do not either any longer or anywhere near the volume that they used to. So with all of that, what else could go wrong? The clean tech investing became a political issue. You see both candidates at Cylinder. Cylinder was a very visible bankruptcy, roughly $400 to $500 million of a DOE loan guarantee had gone into Solyndra, and then Solyndra had defaulted on that. What's interesting, though, is that the DOE had expected, i.e. effectively spent or allocated $10 billion for losses from the Investment Act funding, of which Solyndra represented 5% of those losses. So if you're looking at portfolio theory, you expect some winners and some losers, and all things considered, losing $500 million is not a great thing, but it's certainly within a context of planning for $10 billion in losses is not anywhere near the way the situation was hyped. Roughly only 8% of the companies that have had received money from the stimulus funding have gone bankrupt, 5 of the 63. But nevertheless, this cast a tremendous shadow over the political community of supporting these kinds of investments. So, is there anything else that can go wrong? Facebook purchased Instagram for $1 billion 2 years after the company was founded, and this has started another bubble-like frenzy in the mobile internet app space. And seeing as all venture dollars are really competing for the best returns, this has really focused a lot of interest in the investment community on putting $25,000, $50,000 into some app and receiving tremendous returns from this. So these have made very difficult headwinds for starting a clean tech company. So with that background, why start a clean tech company during this period? Well, there's really one need, and that is there's a huge opportunity. The market size in the energy space is $1 trillion of market opportunity versus the internet space, which is billions of dollars of market opportunity. The embedded capital, the annual spend, pretty much every metric, the big winner in clean tech is market size, and so it's very challenging to get into that market, but that's why you want to be there. Is that a success in the clean tech space has just such tremendous upside. So, given that, we need to be smarter in how we get to the market. And as I mentioned earlier, here are two companies that I spent some time with earlier in my career. Ballard Power Systems was developing fuel cells for the automotive space, and Audra was an Australian company that moved to California to develop concentrating solar thermal plants. Both companies, one was going to the automotive market, one was going to the utilities market, ran into this problem that I mentioned earlier. They had unproven technology, and by unproven, I mean unproven in terms of what the end customer feels. Ballard had thousands and thousands of hours of operating fuel cells of all sorts of different configurations for different markets, but that doesn't mean much when an auto manufacturer is looking at their volume of production and the consequences of being a first adopter. Likewise, there's a financing risk issue. Audra had built around, I think, 5 megawatt-ish size plant, and their next goal was to build a large utility scale plant. And to be fair, they started looking for this money in 2008, 2009 time period when capital was scarce. But there was a real step up from what they had built to what a utility scale installation was. And to build a large utility installation, you need hundreds of millions of dollars of debt and equity. And the debt providers just aren't going to be there. There's been a saying that everybody wants to be first in line to finance the third installation. And so to get a large-scale utility installation off the ground, you really need some other path to market. The nuclear industry did this with government money, but that's been the biggest problem with the clean tech industry, and that's why we focused on the solution that we had. So here are here's the pathway that we got there. In 2009, I received seed investment from Idealab, and for 18 months the company had one employee, which was me, which basically I spent time on market discovery and exploring the technology. This company was not founded around any particular technology, which is actually somewhat unique to most clean tech companies. Most clean tech companies are spun out of, say, a government lab or corporate research arm to specifically commercialize a new solar cell or a new biofuel set of microbes or something along those lines. Energy Cache was not founded that way. Energy Cache was founded to explore the opportunity in the energy storage space and see what we could come up with. And so really the catchphrase was iterate, iterate, iterate. The try stuff, try it quickly, reject things, try other things, look at markets, and that was really the way that the company was operated during that time. Without spending a whole lot of money, I was able to look at a number of markets and a number of technologies. I explored a whole suite of things. And that freedom to do that was a big part of why we were able to come up with the solution that we had. Once we had a solution and built realized, there's a big opportunity with gravity storage. Well, what are the problems with pumped hydro? Well, the footprint is enormous, and you can't build a pumped hydro facility anywhere. Is there an opportunity to make that system modular? Can you deploy that on disturbed land? We built a small-scale garage-size installation to validate some of the questions that we had, and with the backing of that, we were able to obtain financing for our Series A round from Bill Gates and from Claremont Creek Ventures. With the Series A money, we then grew the team, built that demonstration unit you saw in the video, and the real important thing for this period is to build fast and cheap. The team was very small. This allowed us to move very quickly. We sized it was an interesting challenge because we had to build the machine. We're measuring frictional loss, we're measuring kinetic energy and momentum, and these things don't scale well. You can't build, a model train running on a cable has nothing to do with the physics of a full-scale locomotive. And so we needed to build something large enough to collect meaningful data, but small enough that we could iterate quickly, because there was a lot of welding. Everything weighed thousands of pounds, but we sized things so that all the parts would fit on the back of a truck. That was sort of a requirement, that we had to be able to move things around and be able to collect data. So, but from the time we raised money until the time we began our installation through our design period was only a period of about 6 months. In parallel, we were growing our partnerships and our customer base. We didn't know. We wanted to borrow technology from the mining industry, but none of us had come from the mining industry. We were all mechanical engineers, but not focused on the mining industry. So a big part of this was reaching out to local, turned out to be a large domestic mining company, and getting their expertise on efficient ways of loading and unloading the material, of how to handle a wire rope, of how to of various design constraints to stay within. And that partnership has worked well for us. We now we have our first initial customers come from those partnerships that we forged while we were in the development of this product. And we found that people were very receptive to being involved in the early stage development of something. It's an industry that doesn't see a lot of wacky startup engineering types trying to do something, and so we received a lot of engagement from the people we reached out to, and that was very important, both for our credibility but also being able to reach our goals. So there's really 2 lessons learned, and I think these are things that I specifically did not know the right path to proceed, say, a year ago, and definitely would have done things differently this time around. And the first is promotion. My attitude for the longest time was this wasn't a consumer play. We didn't have to impress. Our end customer were going to be utilities or mining companies or large industrial players. We would be speaking with them on a one-to-one basis, there really wasn't need to generate a lot of hype and buzz in the media. All things considered, it would be best if we just kept our heads down, worked on the product, and worked with the relationships we had. And yet, I think that's false. Promotion is actually probably a lot more important than you think, even if your end customer is someone who isn't a consumer play. And the reason for that is promotion tends to feed upon itself. We originally did not broadcast when we received the funding from Gates Ventures. Gates Ventures themselves eventually made comments about that, and then we could talk about that. And after that point, we received all sorts of media inquiries, which led to greater recognition, even within the community we wanted to approach. So people at utilities knew about us, people saw our video online. There's just general momentum which comes from dealing with investors, for dealing with potential new hires, for dealing with customers, for getting this kind of promotion. So even if your target audience isn't someone that you think you need to have a media presence for, it actually probably is. There's a much larger stakeholder community than I was originally thinking of. And the second thing is really having no fear of failure, which is difficult to do, honestly. When you're an entrepreneur, often you make a lot of sacrifices, you put a lot of you risk a lot to start a company, and it's hard to then have no fear of failing when you have that much on the line. But fear really drives irrational behavior. You will have a lot of doubts on whether you're doing the right thing, on whether or not whatever path you're pursuing, whether it's the right one, that's okay. But if you have no fear of failure, if you recognize that this is risky, and you have a fiduciary duty to your investors and your customers, and you make sure you do right by them, then there's a certain freedom which comes from following that path. And I think one of Idealab's biggest strengths as an organization, Idealab is an incubator, a company that develops companies, and they're extraordinarily good at starting companies. They've developed over 100 of them, in both in the energy space and the internet and software space. And Bill Gross, the founder and CEO of Idealab, who's on my board, I think his biggest strength is the fact that he's just a phenomenal cheerleader, and really pushes people to try things that might not be obvious. And Bill's been a big reason why the company has been as successful as it has been, and why other companies have been as successful as they are. And that comes from the culture that he's created within Idealab, which then in turn I've tried to push down within Energy Cash, that achieving big things takes big risks, and as long as you recognize that, then that's the way to proceed. And so it's a bit cliche to say have no fear of failure. There's even a Steve Jobs quote talking about, if I try my best and failed, at least I tried my best. A number of people have talked about it, but I've really experienced that as well as my two lessons learned from running this company. And then I've been asked to talk a little bit about the experience of LGO and how it's gotten me to this point. And I'd like to sort of lay out where I've been in my career as a bit of a framework for that. And then I'd be happy to just take questions about anything that I've talked to in the last 30 minutes, from the company to the financing to lessons learned. But LGO was a very sharp change in my career. Before that, I'd been working as an engineer doing product development, but LGO enabled a bunch of things to get where I am today. First off, right post LGO, I was in kind of the corporate slash startup mode. I worked for a small company and a startup solar company. And the thing that I really focused on there was pursuing as many different opportunities as I could. So AeroVironment was a company with several hundred employees that were building solar vehicles and unmanned airplanes and a variety of technology products. there was a lot of, during that time, I was given the opportunity to start up a manufacturing facility, to write the marketing plan for a launch of new products, start a couple of new divisions. And the thing that I would stress there is, based on what I had learned in LGO, I really had that flexibility to be able to pursue a number of those things. And that was a big deal. When you're in a growing company, the ability to take on a number of roles, particularly undefined roles, is a really big thing. And that also led to me learning a number of areas of the company, which I've then continued to use to this day. The next phase I would call the investor phase, and this is where I was approached by Starfish Ventures to be a partner in their firm. And there were a number of factors. Being in the startup community, obviously having a finance focus, the MIT brand name undoubtedly was a big part of things. This was part of Starfish being able to raise funds from their investment community. They needed to show they had the team that could execute on their investment thesis, and I'm pretty confident I wouldn't have been given that opportunity without the background that I'd had. And so that was a very important change from the operational side of things to the investing side of things, but that was critical to be able to do what I did next, which was, after coming back from the investment phase, I would call this is now my entrepreneurial phase. Work with the X Prize Foundation in identifying potential opportunities for an energy and environment X Prize led me to see some of the value in storage, and the experience that I had at Starfish in financing deals was absolutely critical in being able to get energy cash off the ground. So it hasn't been a straight line, and several times along the way, it certainly did not feel like a straight line, and yet what I found is always by pursuing sort of the opportunity that I would learn the most, or get into an area that I hadn't been into before, where what I had done previously was valued. That's really led to what I've been able to accomplish to date. So that's a bit of a roadmap there. But I'm more than happy to open this up for questions now. We've got a reasonable amount of time, and talk about any of the things that are talked about so far.
Great, thank you so much, Aaron. I've got a couple questions in the queue. Let me start out with one from LGO alum Mark Chu. He asks, can you walk us through the process from focusing on energy storage to deciding on the solution or technology you did? And he asks, was this mostly driven by economics or by other factors?
So the first thing was identifying what's the problem. I mean, the thought was there were a lot of people working on batteries and flywheels and ultracapacitors and compressed air, and I think that's all of them. But the original idea of energy cache was technology focused. We actually said, well, I took something I had done way back in my fuel cell days with liquid hydrogen, and thought, well, we could, refrigerate air and cool it down to liquid, and then use it to recover waste heat. And then we rejected that idea because the market really wasn't there. The way you would get paid for waste heat recovery didn't make sense with the economics. So once we settled with energy cache, the thought was, well, what is the problem today? Or what's the main solution today? And that led to pumped hydro. Okay, well, what's the problem with pumped hydro? Well, it's too big. There are no sites available to build pumped hydro. But why is pumped hydro a good thing? And the answer is because the utilities understand a mechanical system. They like the fact that it stores hours of energy. They like the fact that it has fast response. And so the thought was, okay, let's list all the good things about pumped hydro, because that clearly works today. You talk to anyone in the utility, and given they'd say, given the choice, they'd just take a pumped hydro system. So could we build a pumped hydro system that had a smaller footprint? And the thought was, okay, well, to have a smaller footprint, you need denser material. Water is 1,000 kilos per cubic meter. You need something much more than that. So we started lifting, the idea of lifting steel up a hill or lifting concrete blocks. We needed really heavy stuff. But then, then this is where we turn to economics, because by modeling the cost of the system and modeling how much we could get paid for it, we were able to pretty much determine, we need to hit these efficiency targets, we need to hit this cost target. So without even knowing what our solution was going to be, we had pretty much mapped the space that whatever it was, it had to fit, these parameters. And that is what eventually led us away from steel and concrete to gravel, because it became glaringly obvious the metric that drove everything was dollars per pound. We needed the cheapest, heaviest material there was. And although steel was really heavy, anything processed would blow your economics out of the water. You couldn't even afford concrete. Crushed rock was heavy, almost twice that of water, and very, very, very cheap. And depending on what sites we go to, possibly free. And so that really drove the design in that direction, which then, once we had that, it was a matter of, okay, we need to figure out an efficient solution for loading and unloading, and a bunch of the other parameters came from that. So really, the process was looking at the existing solution and then sort of following the logical path of how you solve its problems while hanging on to the value that people like it for in the first place.
Okay, thanks a lot. I like that exchange a lot. Here's another question that was provided by a current student. She asks, how do you see energy infrastructure changing as we rely more on storage?
Well, what's going to happen is that there'll be less of a build-out of peaker plants. So it's not so much the existing infrastructure is changing, it's that what would have happened won't necessarily happen. There'll be less of a reliance on building out peaker plants to handle peak load. The second thing that's going to happen, again, not necessarily from storage, but just from aging, is that, and this is happening now, is that existing assets will eventually be retired, such as coal plants, and newer assets, such as renewable energy, are going to come in a big way, except that that picture looks very ugly without storage. And so really, if you throw on the kind of low carbon generation sources that people want, then you really need storage to help mitigate this. And it's not just any one angle. I mean, independent of renewable energy, you still have the peak demand, off-peak inefficiency, which is which would somewhat be mitigated by massive adoption of electric vehicles pushing charging to the nighttime. But there's a whole bunch of factors that are happening at once, and storage is really a management tool. Particularly what we're developing, being a bulk storage solution, but that also has a fast response rate, the need for storage is also time dependent. You need storage for one problem where you need hours of storage, and another problem where you need to be able to respond within seconds. For example, cloud cover going over a solar panel and dropping it several hundred megawatts off the grid. And so there's a real opportunity for a number of different storage solutions to serve these needs. And that mix is what the grid is going to start looking like.
Great, thanks a lot. Here's another question. Scott Jacobson asks, can you talk about the results and the status of Energy Cache and your next steps?
So well, I can't talk so much about our results in this forum, but the goal was to validate a couple of the key economic drivers. So we wanted to make sure that we could hit our cost targets, we wanted to make sure we could hit our efficiency targets, and we wanted to validate that the speed of which we could respond, we could hit those targets as well. And those were driven by the market. So if you can respond quickly, you can get paid for that service, and that's something that we wanted to validate that we could do. So we set the goals for our Series A of, okay, these three criteria have the biggest influence on the overall economics. So let's hit those first. There are other targets, operational costs, lifetime, things like that are important but aren't as big an impact as the first three. So we built this machine to validate those first three, and we've been really pleased with the performance that we've seen. So what we're doing now is moving forward at building a larger scale version that will be basically be a commercial scale installation. A full commercial installation will be an array of these things, but we can build a small scale array at full size to validate validate the remaining economic figures. So what we're then going to have is not, we will then have a full size installation with operational data, which we can show customers to begin developing commercial installations. But that's how we broke it down. We basically looked at it and said, okay, we want to do this cheaply. We want to prove the most relevant things first for the least amount of money, and then work our way down the list. And that's really driven why we built what we're doing and what we're doing next.
Okay, terrific. If anyone else has a question, please send it to me in the chat. One of the questions I had was, I think you know Jim Miller of Google, Aaron, and probably others on the call do too, who's the VP for Worldwide Operations, and one of the things in his domain is how they manage energy. And I'm just curious as to whether, obviously you're focusing primarily on utilities right now, but is the technology that you're exploring creating any interesting discussions with other industries?
So one of the things we're focusing on is we have a far smaller footprint than, say, a pumped hydro facility would be, but we're still a transmission asset. I mean, one of the major benefits of, say, battery technology is that you could place it at very specific points on the grid, and this, I think, will help overcome some of the disadvantages of battery technology in terms of cost and lifetime and various other things. Because we are a transmission asset and we're trading in the wholesale market, we are very cognizant on costs, and we need to have a large economic solution. So you're not going to install something like this at a server farm, for example. We do have an opportunity with large industrial customers, particularly mining sites, where they're particularly off-grid mining sites. So we've had some interesting discussions with a number of mining companies in Chile that have tremendous terrain, very poor access to the grid, very expensive electricity prices. Their next best alternative is using diesel backup. There's a lot of interest in solar, but the mine runs 24 hours a day and solar doesn't. So there are industrial players that are really good customers for us, but they are customers who are in specific locations, either with good terrain or with poor grid infrastructure. If you're a customer with great access to the grid, then generally you'll be served by the grid. And what we would do is we would serve the grid, but there's no need for us to be co-located next to any specific customer. There's just to give you some idea of the flexibility of the grid, in California, there's a nuclear plant that was built called Diablo Canyon, and on the other side of the state, there's a pumped hydro facility called Helms. And Helms was built solely because the nuclear plant couldn't shut down at night, and yet demand was going to drop at night, and there was going to be this overgeneration problem. So they built the pumped hydro facility because of the nuclear plant, and they're nowhere near each other. So the ultimate demand will come from specific industrial customers, but that demand will be then filtered into the requirements of the grid, and that will be served by all grid participants, including us. So we are talking to specific industrial customers, but they are a very select set that makes sense for us to engage with directly.
Okay, thanks a lot. Here's another question. Do you need government incentives or policies to make the technology work, such as renewable portfolio standards, or can you succeed without major regulatory changes?
Well, it depends on the market. So in Chile, the answer is the market as it is. There's significant demand that there's an opportunity there regardless. In Europe, in North America, elsewhere, the entire electricity grid is government run. In fact, one of our investors said, it's government all the way down. The whole industry is regulated, and so and that includes traditional generation versus renewable generation. So the way the grid is set up is basically to meet a bunch of policy goals, and the current policy goals are for adoption of renewable energy, And so an RPF standard obviously is driving the market that we're interested in. But it's not solely driving the market that we're interested in because, again, independent of renewables, just managing the grid, another policy goal is to have the minimum cost for ratepayers. I mean, as much as people like to think that the electricity market is a free market, in some cases it's freer than others, but ultimately it's still a very regulated market. So to reduce costs for ratepayers, there's still tremendous interest in storage assets because they're a more economic solution than building out transmission infrastructure or building generation plants that are only used for a very small period of time. All of our economic modeling takes very sort of reasonable assumptions on the growth of renewables, on incentives that exist, as well as having sensitivity analysis on, okay, how would things play out if some of this stuff went away. So we are assuming certain adoption based on renewable portfolio standards, and that's, we think, is the reasonable expectation of the way the market would go. How ultimately the market shapes up is determined by a bunch of factors such as natural gas prices, economic growth. I mean, the recession for 2008 till now has caused the influence on oil prices. So I guess the short answer is I can't say definitively whether what government policies are needed or are not needed. They're certainly needed for early stage product development and ARPA-E and other loan guarantees and other projects like that, which have been done within the Department of Energy going all the way back to nuclear power, are needed still because of this. It's not a very clear financing path all the way through from initial development through to utility scale adoption, mostly because the utilities are forbidden from taking technology risks. So the government definitely has a role to play. Which roles they play and the influence of that, it's the responsibility of entrepreneurs like us to respond to that and to try to build the best business within the regulatory framework that already exists.
Okay, thank you. And finally, another question asks, is there a market mechanism which can make energy storage business separate from energy generation, so customers pay more when less renewable energy is available?
Well, the closest thing would be time-of-use prices. So the wholesale market operates under time-of-use pricing. It is real-time pricing, basically. The prices of electricity fluctuate in response to demand and supply. Large industrial customers typically are exposed to time-of-use pricing, which is sort of a ham-fisted way to reflect that market. They're not exposed to real-time pricing. They're exposed to preset slots that peak times between 3 and 6 you'll be charged this, and at night you'll be charged that. And those numbers still are fixed. It's sort of an attempt to match the real-time pricing that occurs in the wholesale market. Residential customers are completely shielded from that volatility, and that's a political issue. I don't think that I mean, there's a driver to go towards that way to shape demand by having people see what the real-time prices of electricity are, but there's a lot of resistance to that. Customers don't want it, even if it would be overall more economically efficient, therefore on average lower cost for everyone. It's really something that people don't want. Politically, it's something that nobody wants. If you think about it, so if you don't have time-of-use pricing, then people who are using electricity during peak demands are getting subsidized by people who aren't using electricity during peak demands. And if peak demand is in the afternoon and most people are away at work and not at home, then the people who are being subsidized effectively are people who are at home during the day not working, which is stay-at-home parents and elderly, which is not a political group you want to go after and charge more for. I mean, so there's a lot of reasons why the system is set up the way it is. But that has caused problems. I mean, California's catastrophic electricity fiasco 10 years ago, or more now, was caused by a broken structure where the utilities were forced to buy electricity at the going rates, but not able to pass those costs along to customers. So customers were using power at rates far below what it actually costs to produce, which eventually led to the bankruptcy of a couple of the utilities. I think there's some demand smoothing, encouraging people to run appliances at night and things like that. I think it would be efficient if people were exposed to real-time prices, but I think there are a lot of reasons why it's difficult to adopt even in the industrial and commercial sector, much less the residential sector.
Okay, and one last question. Do you envision customers of your technology that would own one of the installations standalone, buying and selling power to the grid at variable rates?
Yes. Yeah, that exists today. They're called IPPs, independent power producers. You can, if you want, call up GE, buy a gas turbine, plug it out into the grid, and operate your own generation. So that is a market, that's a commercialization mode we can adopt, which are standalone, independently financed and owned installations. They're owned by customers who want 30 years of cash flows. There's a lot of investors that want 30 years of regular cash flows, and they just buy and sell peak and off-peak power, sell services to the grid for fast response, and collect the revenues accordingly. And that is actually the easiest market to model, because there are certain areas of the country where the pricing is very transparent. You can exactly see how that business would shape up, and that's what we've actually used for our modeling. That's not the only market, but there's certainly a market to do that, and so we can see that that's probably how these things will be deployed at large scale initially.
Is that something that Energy Cash is imagining it might operate on its own?
It depends. I mean, that's really driven by your balance sheet, your cost of capital, your interest in doing that sort of thing. That generally isn't consistent with the timelines and cost of capital of a venture-backed company. So I don't know if in some permutation in the future Energy Cash ends up doing that. Right now we're not, there are people who do project development and own assets like this. It's a well-developed industry with solar, with wind, with traditional generation. It would make sense for us to partner with people like that. It's certainly not a near-term priority.
Okay. Well, Aaron, thank you so much for sharing your time and insights with us. I appreciate everyone who joined us for the call. And I'd like to invite you to join us again next week at this time when we welcome Matt Voken, another LGO alum who is helping run Motorola Mobility post-acquisition by Google. Aaron, thanks a bunch.